So here we are, we're in June, week number 4. Now I've already gone ahead and uploaded the bank feeds for June week number 4 in the download files. And now let's go ahead to the paperwork. We're going to start with the charges, and we've got a few to start with here. Let's go to this Metro June 22nd, and it is a good one. We can see we've got all sorts of notes written on here. And we can see that it's a Metro receipt. There's a couple of items that are business related. The rest is personal, but the entire thing was actually paid for on the business MasterCard. So let's go ahead and put this one in together. So we're going to go New, Expense. This was Metro, paid by the Triangle MasterCard, and that date right here is June 22nd. And we're going to say that the first category here, so we've got bathroom tissue. You can see there's an H on there. So this bathroom tissue has HST, but the garbage bag tags for disposal, you can see there's no H. There's no sales tax on those. So we're going to say supplies. And this is the bathroom tissue at $17.99. And there's HST on that. And then the next one is disposal. Do I have disposal? Yep, disposal fees. So those are the garbage bag tags, and that was $50, and that is out of scope. The total amount that is business related is the $70.33, but the amount that's hit up the credit card is $118.37, and the rest, she said, is personal. So we're going to say that this is owner's draw. This, and we're going to put in the math of 118.37, so the total minus what the total is that was business, so 70.33, and again that's out of scope for tax. So now we've got the total car charge in 118.37, so we'll reconcile the MasterCard, and we've correctly allocated the expenses to the right buckets. So we're going to go Save and New and see what's next. So next we have McGroots. And McGroots here we can see, so it does look like a bill, but because the payment is the same date as the invoice date, only one invoice is being paid, and we don't have to track a payment number, we can just put this in as an expense. So let's put that in together. So let's go ahead and say McGroots here. And you can see my page shifted. I'm going to expand this. You can see that because we have this overpayment, this credit here of $365, it's just letting us know, hey, you've got open bills here, which is actually an open credit, but are you sure that you want to make this an expense? And I think this is probably because some people would put in the bill and then go to pay the bill with an expense and inadvertently double enter. So I think that's part of why QuickBooks has that there, but we are going to clean that up at the end of the month. And right now we're just going to put in this charge. So the date was June 22nd, the reference 8833. And the category is purchases and materials. So the first charge was for the mulch, second for topsoil and delivery. And I have discussed how some people might want to track that delivery separate, but the way that I'm tracking it in this file is the delivery is part of the cost of acquiring the cost of goods sold, the materials. So we're just going to put in the subtotal here, HST, and so 73450, 73450, save and new. Let's see what's next. So next, there's an Edger Lease. So now is a great time to talk about leases. So there's two main types of leases. You've got the Capital Lease and you've got the Operating Lease. Now, an operating lease is basically just renting something, right? So if you're leasing an apartment or you're renting an apartment, at the end of the lease, you either renew the lease or you leave. And if you're leasing a car, and I'm talking about leasing a car like personally, I'm not talking about in business, but just think of outside of business, somebody leasing a car, generally at the end of the lease term, they give the car back, right? Though they do have the option to buy it out for a sum of money that may or may not make sense. But these are called operating leases because you're basically renting the thing. Now, a capital lease is what I call a fancy way of financing, right? So basically, a capital lease is you're not just renting it, you're leasing it, and the buyout option at the end is a no-brainer, right? The buyout option at the end is really small. You might it's basically a glorified type of finance, and that's what we call a capital lease. So to go back to the example of leasing a car, but not in the business world, just leasing the car. At the end of the lease term, you look at the lease and you're like, do I want to buy the car for $20,000 or whatever the buyout amount is? Or do I just want to release? Or do I want to buy a new car? Like, you've got all of these options. It's not a no-brainer. You sort of have to hum and haw about it. But if it's a capital lease and the buyout is like $10, it's a no-brainer. Like you $10, you take the car, it's yours. And so you can see how that sort of capital lease is a way of glorified financing. But it's not the same as a loan. So we saw an example of financing already when Sarah bought the truck, right? So who bought the truck? Sarah bought the truck. Now, she's a sole prop. If this was an incorporated business and the corporation was going to buy the truck, then the corporation's name would be buying the truck, right? But then they go to a finance company and they ask for a loan. So the loan is in Sarah's name or the business's name, and the purchase of the actual asset is in the business's name. And because of that, that's a loan. She got to claim all of the HST because it's her truck, but she also owes a ton of money. Whereas a lease, it's actually LeaseCo. LeaseCo is the one who is purchasing the Easy Edger. And because of that, LeaseCo gets to claim all of the HST on that purchase when they buy it, that HST credit. And Sarah, you can see, she has to pay this $103.73. And when we look down at the details of that, that is actually $103 plus $13 HST for a total of $117. So when it comes to a lease, no matter if it's an operating lease or a capital lease, the HST is actually claimed with each of the lease payments. So whether it's a lease that's sort of just renting it and you give it back at the end, or if it's a capital lease, like a glorified way of financing, and you buy it out at the end, you can see that the HST is going to be claimed in little bits over time like this. We can go back up to the beginning of this lease paperwork and we can see actually that the option price, so that's the buyout amount, is $10. So if you've got like a $10,000 piece of equipment that you're leasing and at the end of the lease you either give it back or pay $10 and the ownership gets then transferred into your name, obviously $10 is a no-brainer. So that's one of the ways that you can tell the difference between an operating lease, where you're just renting the equipment and at the end you either give it back or decide to buy it for an amount and it may or may not make sense, or a capital lease, a type of financing in which the buyout option is practically a no-brainer. So when it comes to bookkeeping and accounting, what is the difference in how we treat the leases between the operating lease and the capital lease? Well, in both of the scenarios, generally in the bookkeeping, we would put in, for each of the lease payments, we put it in as equipment lease expense. And then we also claim the HST on that, as outlined by the HST breakout in this section below. And we'll do that whether it is a capital lease or whether it is an operating lease. And this is also true from an income tax perspective. So when the taxes are done at the end of the year, we're not seeing an asset on the balance sheet and a loan out to the lease company. What we see is just lease expense claimed over the fiscal year. But that is only from an income tax perspective. Remember when I said the financials are different for an income tax perspective versus just sort of like the GAAP, generally accepted accounting principles perspective? This is when I was talking about depreciation. There's a certain way that we claim a capital cost allowance, CCA, the amount that we can claim related to how the asset devalues over time. It's a structured way, there's a tax way, and that's the way that we do it for tax purposes. But the financials for like GAAP purposes, you can depreciate it in the most realistic way, like straight line or over the course. Actually, it's going to last 7 years and all those sort of things. Because the GAAP financials, you don't want to see based on tax rules. You want to see legitimately how well is this business doing? What are its assets balance at, right? What are its loans and liabilities balances at? And that's where this difference between the operating lease and the capital lease comes in. What's going to happen is the accountant, when they prepare those financials, they need to know that this is an operating lease. They need to know how much the asset value is. So that's why that quote is in there, and then see the details of this capital lease so that they can show what the asset value actually is and what the loan liability actually is. Even though it's a lease, on the GAAP, actually what's happening financials, you want to see the asset and you want to see the liability. So from a bookkeeping perspective, it's important for us to make sure that we have that paperwork to give to the accountant at year end for all of the leases, right? So that the accountant can ascertain if it's a capital lease or an operating lease and make sure that if they're going to create those GAAP financials, not just the tax financials, but the actual GAAP ones, that they're going to have a better representation of reality when it comes to these leases. Also, you're not always going to get a quote like we did for the Easy Edger. Sometimes I think the accountants need to just use fair market value to put those together. But you can see how having the quote for what the actual asset would have cost if Sarah had decided to buy it instead of doing a capital lease, that's going to help them with their work as well. So that's a bit of a long-winded way to explain why we're just going to put this to equipment lease expense. But I think it is very important for both business owners and bookkeepers to understand the difference between a capital lease and an operating lease for two reasons. First of all, so that we know what paperwork we need to give to the accountant if they're going to put together those GAAP financials for the business owner. And perhaps that business owner in that specific business wants to see their bookkeeping done on the GAAP financials way of having the loan, the liability, and the asset purchase on the balance sheet. There are ways of doing that, and that's for another video, but it's probably more specific to how the accountant wants it done in the bookkeeping. So we're just going to put this right to equipment lease expense. Another note on this is I don't just use the GL account name lease expense because that's one of those other squishy ones. Like a lot of people use lease expense, for example, for the rent of the commercial space that maybe the business is renting. And because it's sort of vague and ambiguous, I don't like to use it. I create a GL account called equipment lease expense, and I use it for equipment lease. Or I might have one that's called vehicle lease expense if there's a lease with a vehicle. And then for the property rent, I just call it rent. So that's a Naomi way to make things a little less ambiguous and a little less vague. So let's go ahead and put in this initial payment of $319.17 together. So who is she paying? She is paying LeaseCo, and she's paying that, we can confirm, out of the operating account. Let's take a double check and make sure that it is coming out of the Canada Bank. So the amount is $319. So I'm in the Canada Bank transactions, and I'm just going to quickly look up $319.17, and we can see, yes, it is coming out of the Canada Bank. So she's paying LeaseCo, and she's coming out of Canada Bank, checking. And that date was the 23rd, I believe. Yeah, June 23rd. And we could put the lease number in there if we wanted. But I just took a look and there's no lease number on this one. But if there was a lease number, you could put it in there. We're going to say that this is equipment lease expense. And as I mentioned before, it's important to indicate what is being leased in the memo here. And it is this Easy Edger right here. So let's put that in. It is the BE400 Easy Edger. And then we'll say SN 987-987-8874. Excellent. And the amount of this payment specifically is $319.17. And we'll just say inclusive. I'll put that back again, $319.17, like this. And that's inclusive. So you can see if you were to add up all this GST, HST, it would come to $36.72. Another thing that's important, I feel, to do when we put in the first lease payment is you're going to want to put in the actual lease paperwork right here. So we would attach the quote and we would attach the lease itself. Conveniently, we're still at week number 3, and that was last week, and this is where the quote is. So I'll put the quote in, and then I would also add and go back to week number 4. We're in charges, and let's put in this quote right here, open. Now, don't assume that the accountants know that those attachments are there. Not all accountants know. So I would definitely include both of these in the year-end paperwork that you give to the tax preparer or the accountant. But whenever there's a reoccurring charge, right, I like to put in the paperwork on the first instance of that charge. And I want us to make sure that we have this easy Edger description lease the next time the lease gets charged. And so what I would do is I would probably also take a look at the July transactions and find the one for 117.21. I would start that, I'd put that description in so that moving forward we would know that the 117.21 is for the easy Edger lease, and this first payment right here is the one that has the items attached to it. Excellent. So let's go save and new and see what's next. Next, we have an e-transfer. So what we have here is an e-transfer sent to Kamal Ahmad from Grand Gate Gardens. And the message is advance as per our conversation this morning. So Sarah is giving her employee an advance of $250. So let's go ahead and put this in. So here we are in the expense screen, and we're going to put in Kamal's name. Now you'll see that there's 2 Kamals. There's Kamal the employee and Kamal, an employee in the name of it, but also set up as a supplier. Now this was set up when we were doing the manual payroll. If you weren't going to use QBO, I did illustrate how you would do payroll manually and put that information into QuickBooks. But if we were to select Kamal the employee right now, there would be no like succinct list of all of the e-transfers that we sent to Kamal, because you can't look at a transaction list of expenses from like the employee name. And if we were to go to the supplier list to see, transactions, Kamal's employee name wouldn't show up. So even if you haven't set up a supplier name called your employee's name for this advance, I would suggest doing it, because otherwise it'll be you won't be able to see a list of all of the non-paychecky things. So let's go ahead and select this supplier option, payee from the list, even though it's got employee in brackets so that we know it's not actually a supplier. And the payment account is Canada Bank Checking. It's the 23rd, and we can say e-transfer here. So the category is advance. So in QBO, it's created the advance category already, and it is set up as on the balance sheet. So technically, employee advances is a current asset, right? Because we've lent money out and we're expecting it back. But QBO has all of sort of the payroll related things sort of under the current liability section. So that's just, and we'll see what that looks like later on when we do the advance repayment. So we're paying it out of advance repayment, and then we're going to get, receive it back into advance repayment, thus making it a zero balance GL account. Now, if you're not using QBO Payroll, this is what I would actually do. I would create a GL account called Employee Advances, and I would say add new, and it would be a current asset, so that's something that you're expecting within the year. And you can even see employee cash advances is the detail type, and the default tax code would be out of scope. So that would be what I would do if I wasn't using QBO Payroll, because QBO Payroll is the one that created that advances GL account. So I'm not going to save that now because we're using the QBO Payroll in this case study, but I was just illustrating what I would do if we weren't using the QBO Payroll. So let's go ahead and just put in that weird advances category, advanced category that QBO created, 250 out of scope, like this. And we're going to go and save and close. The reason I'm saving and closing is I just want to show you from the QBO perspective why we can't run this payout through QBO Payroll. We can only run in the repayment through QBO Payroll. So if we go over to the payroll, over to employees, and we select Kamal's name, and down here we can add deductions and contributions. So let's go and edit this. And here is where we would add a deduction or a contribution. So I kind of wanted it to be like a contribution and a deduction, like an advance given, and then an advance sort of deducted from the check when it's time to come back. But you can see that we only have other deductions, like there's no other contribution choice, and it's not other deduction / contribution. Now they do have advance in there, but it's just advance repayment. So it's not able to sort of track advances given out. It can only track advances like clawed back. So that is a limitation of QBO Payroll that I don't appreciate. And we will talk more about setting up the repayment when we get to the paycheck, because you'll see the paycheck this week is where Sarah also takes back the $250 that she gave Kamal at the beginning of the week. So we'll come back here, but I just was illustrating that you can't you can't run a payroll paying out in advance. You can only track how much you've gotten repaid back from the employee. So don't really love that, but we will look at that in a little bit. So let's take a look at what is next in here. We have an Esso receipt, and it's just a straightforward Esso receipt, nothing funky or interesting going on, but let's go ahead and put this in. So we're going to go New Expense, and this is Esso, Canada Bank checking. Oh, and actually it was, paid out of the MasterCard. I just remembered that that's what we did last time. And this was $625. I'm going to say MC for the reference number. Last time we used auto diesel, I did mention that I don't really love having these diesel versus gas like I thought I would. Initially, I thought it would help us to know what gasoline was for the car and what was for the truck. But if you see an Esso charge and you don't have the paperwork, then you don't know which is which and you're forced to choose one. So I would say moving forward, I wouldn't use auto diesel and auto vehicle gas separately. But this is how it's set up right now. And it is just at $94.38. And that's inclusive. That's going to include the HST of $10.86. And we're going to go save and new and see what's next. Next, we have a McGroots. And we can see that there's nothing super interesting going on. We're just going to put it in. Basic, easy. And so here we go. We're going to say it's McGroots. Triangle, and I'm going to push that back over. This was June 26, and that was 8847. Now I didn't remember everything from before because it's got an open invoice, and so that open credit memo or that open overpayment that we're going to clean up later. So because it gets tripped up by the fact that there's something open, it's no longer populating what we used last time. So that can be, if you have a very complicated one that you want to just repeat, I would just duplicate the one you've already entered. But this is just one line, so we'll just go ahead and say this is purchases and materials, $12.60 pre-tax with HST. And let's just make sure that the pennies are right. Yep. 142380. We're going to go save and new and see what's next. Next, we have a Signs and Wonders Printing. Here we have a bill from Signs and Wonders Printing, and it is for t-shirts. And so we're going to put that to advertising. And it's noted that it's paid by Business MasterCard, and so we are assuming that it was paid on June 27th. In fact, we could just go ahead and confirm that right now just by going over to the QuickBooks, and we will go to the transactions, and the amount is $203.40. So let's go to the triangle and we'll go $203.40. And actually we can't see $203.40 showing up. So why don't we just look to see if we can see Signs and Wonders Printing in here. Now, Signs and Wonders Printing actually is charging us $672.35. So that's curious. In fact, that's part of what this case study is doing, right? It's helping to illustrate what happens or scenarios that happen in real life, because real life doesn't fit in a box like all of these apps and automations think they do. So here, for example, I've got a note that says, suggested category advertising. Heads up, Sarah called in the MasterCard number and the vendor charged the MasterCard for this bill, but also for a June 10th bill. So this will need to be changed to a bill entry, and then an overpayment on the account is adding by creating a payment that matches what was paid by the MasterCard to this smaller bill amount. So because I want to illustrate troubleshooting at the bank feed, and not like, I do have two sets of documents, right? So my other set of documents doesn't have the Gnome notes. So somebody would be putting in this paperwork without sort of knowing what's going on, right? And so let's go ahead and put this in as if we don't know what's going on. Sarah said she paid this by Biz MasterCard. So let's go ahead and put this in as if we didn't have the note, we didn't have the context, and we didn't know what was going to happen, so that when we do that bank feed troubleshooting at the end of the week, I'll be able to sort of illustrate how we would try and figure this out. I think it also does illustrate how if you're just using your bank feed to enter in your expenses, it opens you up to the risk of being double charged by your vendors and not even knowing it. This is absolutely something that can happen, because just like the business that you're working in and on can be a little bit chaotic sometimes, they are all a little chaotic sometimes. So let's go put this in as if we don't know what's going to happen. So we'll go New Expense, Signs and Wonders Printing, Triangle MasterCard, payment date is the 27th, reference number 7551, and then that category is advertising. And that is exclusive is 180 plus HST, 203.40. So we're going to go Save and New and see what's next. So that was the last of the charges for week number 4. Let's dive into the bills. So we have a Funky Gifts wholesale bill. So these are mugs and planter pots that she is selling in her retail store. So retail purchases COGS, and we'll put the bill payment in also. So this isn't an expense, it's a bill. So we go New Bill and Funky Gifts Wholesale. The date is 6/23 and it is 6/01/23. Purchases retail COGS is already up, and this is an exclusive. So what's the pre-tax amount? 1187.14 with HST ending in 33 for 134. Yep. So we'll hit save because we're going to enter the bill payment also. And once we've saved it, then we can come up here and click the Make Payment. The payment information here is paid with check number 23. So we're going to say that this was paid on the 25th. It pre-populated 23 because the last check we wrote was 22, and that's how QBO thinks. And the full amount was paid, so we're going to go Save and Close. So there's the bill and the bill payment in. Let's see what's next. Next, we have a Dollarama receipt. So we can see here that it's a note that says Canada Day decorations, paid by Kamal, reimbursed by e-transfer. So the note that I have down at the bottom here is suggested category supplies, create a vendor called Kamal Ahmad expense report and add this and the other receipt as lines on a bill. So there's more than one receipt. So the next receipt we're going to see is also going to be reimbursed to Kamal. So the 7040 is not the e-transfer sent to Kamal. And the reason that I'm showing the reimbursed expenses is so this actually comes up quite a bit, and there are actually quite a few different ways to approach it. But there's one way that rises to the top, as through my experience is the best way. So if we were to e-transfer Kamal for the amounts and just say that that e-transfer was actually to Dollarama, if that was reviewed or audited by CRA, like, why are you e-transferring Dollarama? That doesn't make sense. Or if we're e-transferring Kamal and we're claiming HST, it'd be like, Kamal is not like a registered company to collect HST. So both of those don't quite make sense. And then the other way of doing it is putting it through QBO Payroll. And when we do that, we can see that actually there's drawbacks to that as well. And so the best way to reimburse employees for things that they've purchased sort of outside the company credit card or debit card is to actually use what I call the expense report method. So it definitely is helpful to have like an expense report sheet where people list their receipts and submit it to accounting for processing. But actually at some smaller businesses, I don't see that sort of thing happening. People just give the receipts and e-transfer their employees and done. And us as the bookkeepers have to figure out the best way to put that in the bookkeeping. I still use the expense report method in the bookkeeping because it keeps everything so nice and neat and tidy. So for this case study, I'm going to show you how I would suggest to do it. But I'm also going to address later on when we get to that payroll folder, what it looks like if we were going to use the reimbursements option on the paycheck, which the trouble it causes, the workarounds on how to fix it, and how it's extra work and just annoying. So this is the suggested way to do it. First of all, there's actually 2 receipts that are reimbursed to Kamal. Over here, there is a shopper's. So it was actually an e-transferred receipt to Kamal, and Kamal has printed it and given it for reimbursement to Sarah. And again, here's the note: Canada Day decorations paid by Kamal, reimbursed by e-transfer. And this is $12.42. So if we add up $12.42 with $70.40, so $12.42 plus $70.40 equals $82.82. Let's go back to the bookkeeping. And let's go to Canada Bank checking and just look up that amount, $82.82. And we can see there was an e-transfer sent for $82.82. So Kamal is being reimbursed for these 2 receipts. Here is how I would do it. So I would go New, Bill, and the supplier is in Dollarama and the supplier is in Shoppers. So right away, because there's 2 receipts, would you put Dollarama? Would you put Shoppers Drug Mart? Well, I already discussed before why even if it was 1 receipt, using the name specifically on the receipt isn't great. Why would we e-transfer Dollarama? But you can see how having it the expense report method also solves the 2 different vendor name problems. So we're going to call this Kamal Ahmad dash, a 3rd one, yes, expense report. So that is the name of this new vendor, Kamal Ahmad expense report. And then we're going to say that the bill date, and I usually if you're doing it like on a monthly basis, that's helpful, or a weekly basis, you'd use the end of the period. But if it's just a couple of receipts, I like to choose the later date between the 2. So this is June 24th. And what was the other one? And we can see that that's June 24th also. So let's go ahead and put this to June 24th. And the category is, so these are decor supplies. So we'll just say supplies. And then I put in the description. The Dollarama is the name of this specific receipt. And that is June 24th. And here's another thing that I do sometimes, because I do have worked with restaurant clients, is I'll put in what the HST amount is if the HST is not 13% on all of the receipts, so that I can just sort of add up all those HSTs. In this case, the HST is 13% on all of them. But when you're reimbursing people, sometimes it's a run out to Metro to grab some food, like some supplies for the kitchen. If it's a restaurant, some are going to have HST and some aren't. So just putting it in the description helps you to confirm what HST you want to add up in the box at the end. Again, you don't need to do it if the HST is 13% on all of them. And so this is exclusive of tax. It's $62.30 and it has HST on it. And then here we have supplies again, and this is the Shoppers Drug Mart one. And that was also June 24th. And the HST, and again, I'm just doing this for illustrative purposes, but it's 143, HST 143. And the total of that receipt was pre-tax was $10.99 plus HST. It's just on my other screen there. So there's that $82.82. And if we hit save, then we can make payment. And now this is where we will put in the e-transfer. So let's take a quick look to see what the date of that e-transfer was. We can see it was actually paid on the 27th. And because we've entered that bill, now it wants to quote unquote match to the bill. Remember how I noted that if you've got an unpaid bill or invoice, QuickBooks should actually say add payment and match payment. So that's something to note. But let's go ahead and use the shortcut way to add the payment. If we go ahead and match, this is not a bill payment we're matching to. We're adding a bill payment. And then we are marrying the bank feed info line to that bill payment that the bank feed just added for us the shortcut way. So there is the marriage, and there's the bill that we just entered. And that is how I would suggest to do the employee reimbursements. When we get to the payroll folder, I'm going to illustrate how to do an employee reimbursement through payroll, the drawbacks and the workarounds for when that happens. But again, this employee expense report method, whether there's an expense report or not, is always, I found, the easiest way to handle these employee reimbursements through the bookkeeping. So let's see what's next in the bills. We have a Chocoholics bill here. This is Chocoholics Gnome, and these are chocolates or gift chocolates that she sells in her gift store. So this is going to be put to purchases, retail COGS, and there's no payment note, so we'll just put in the bill and wait and watch to see if we get any information regarding the payment. So let's go ahead and put this in together. So we're going to go new bill, Chocoholics. That's June 25th. Bill number is D7237. Purchases retail COGS, and the pre-tax amount is $569.78 with HST for $643.85. Save and new. Excellent. Let's see what's next. Next, we have a Gnome hardware bill. So this Gnome hardware bill is for a PVC rain suit. There's 2 that are purchased, and it's charged to account. Suggested category supplies. Let's go ahead and put this one in. So this is Gnome hardware. Bill date is June 26. Bill number is XZ4530. And I'm just going to get rid of these 2 lines and put in supplies, the $63.98 plus HST $72.30. Save and new. Let's see what's next. We have another Gnome hardware next day. And even though it's in the bills, we can see it's actually a credit memo for $507. And here we go. It's another multi-line thing, except we just put in the PVC rain suit. So she bought 2 and returned 1 of them. And then she bought some potting soil. So when we create the credit memo, we want to hit up for the $31.99, the supplies that we just used when we purchased the rain suit. And then this potting soil mix, that's going to be the materials and purchases. So let's go ahead and put this one in together. So it's not a bill. We're going to exit and go so new under suppliers, supplier credit, Gnome hardware. The date is June 27th. Reference number XZ4578. And so right here we'll say supplies. This is what got returned. And $31.99. So we're putting a positive amount because a credit by its nature is like going in as a negative. So the $31.99 is the negative part of the credit, and there's HST on that. And then the next line is going to be that materials and purchases, or purchases and materials, relating to the potting soil mix for $27.50. And now we'll make this negative $27.50. It's reducing the amount of the credit. HST, like this. So you can see that now $507 is how much is credited to the account. We returned the PVC rain suit, and then we purchased the potting soil. Save and close. And that is all of it for the bills for week number 4.